Lastly, we're going to talk about gains and losses. This is a lot more simple than you think, luckily, as long as we're building off our blocks. So we know that when we receive cash, we get a debit. We know that when we dispose an asset, we have to credit it. And so the plug, whatever is remaining at the end of the day, the cash that we get, and if it's higher than the net book value of the asset, then we're going to have a gain. And if the cash we receive is less, or the consideration, it can also be accounts receivable, right? If the consideration we receive is less than the cash we receive, then we have a loss. The consideration is less than the net book value, it's a loss. So same cash, you can think of the consideration too, because it could be accounts receivables. If it's greater than the net book value, you get a gain. If it's less than a net book value, you get a loss. And if it's equal, there's no gain or loss. And you just have to use your T accounts. And then net book value is just what we calculate after all the depreciation to the period we sell it. So net book value, again, is your gross cost that you originally purchased it for, which includes any of those taxes or fees to bring it to useful service, and then less the depreciation, depending on your depreciation method. So if we discard it, let's say that no cash was received and we're just throwing an asset away because it was fully used and it's no longer usable. It's just a book reclass. So we have debit accumulated depreciation and credit machinery on our books. So if you think about it on the financial statement itself, there's really going to be no change because this is already going to be presented at zero net. The gross amount would be different, but it's going to be zero net because this machinery was already fully amortized. And then to take it off of the books because we no longer have it, we would debit accumulated depreciation and credit machinery. Accumulated depreciation is a contra asset, right? So it normally has a credit balance. So to take it off the books, we debit it. And the same for machinery. Machinery has a debit balance. Normally it's an asset. So to remove it, we have a credit balance. They calculated this by depreciating it over 8 years. Take in mind, right, that we might have fully depreciated an asset and still have it in use, which is why we might still have it on our books. So we would only do this once we dispose of it. So sometimes we might estimate that an asset was depreciated quicker than it actually was because we kept our laptop for an extra 5 years. That's okay, just keep it on the books. That's fully depreciated value. Just because you're using it doesn't mean that you have to change the facts and circumstances at all. There are changes to estimates, which we'll learn down the road, but you don't have to worry about that right now. And generally, I don't see it that much. So what if we just throw something away and we didn't receive cash for it, and it wasn't fully depreciated? So this example is it's fully depreciated to its salvage value here. It isn't. So again, we always have to follow the method. We determine the cost, and then we determine the depreciation. This determine the depreciation for you. So we're saying 6,000 on December 31st, and then it's asking you. So this question is asking you to determine half a year of depreciation expense, and it's already given you up to December 31st. So you have to figure out the depreciation expense remaining and then do journal entries. So we bring the depreciation up to date for the half year, $1,000 a year, right? 8,000, no salvage value, 8 years, $1,000 a year, we're 6 years in, it's asking you to do half a year more. So we debit depreciation expense by 500, 1,000 times a half. And then accumulated depreciation for the equipment, we credit it, and then we have to record the disposal. And so if we haven't fully depreciated the asset, then we're going to debit a loss on disposal. And that's, again, just the plug, right? We know the equipment's worth 8,000, we have to get it off the books, credit the asset to remove it. We have to debit the accumulated depreciation that's remaining. And the difference, we know there has to be a debit because debits have to equal credit, so that debit is going to be the difference. And that if it's a debit, we know debits are expenses, right? So expenses are debits, so it has to be a loss. We're not gonna call it expense. A loss is something that happens outside of ordinary activities. So we don't, this won't be presented as part of our net profit. This will be part of our net income because it's not an ordinary business activity. Again, losses will be debits, revenues will be credits.